Hey, what's up, guys? Happy Thursday. Hey, I wanted to share a couple thoughts on a screenshot that I've seen being shared a lot recently. It looks like this. I'm sure you've seen it. I have clients that will ask me, like, what is my favorite application for tracking mortgage interest rates? This is it. It's called Mortgage News Daily. Great headlines. Today is August 14th, 2025. We can see that mortgage rates hit a new 10-month low, which is fantastic. But there's a couple other metrics that are really important and valuable in their ability to give us, right, the ability to be more knowledgeable, predictive, and set expectations around where mortgage rates are going to go in the coming days and weeks. And those other two metrics are, and these are important to understand. One is the UMBS, which is the Uniform Mortgage-Backed Security, in this case for the 30-year coupon. And then the second is the 10-year Treasury. They tend to be investments that investors will move towards during periods of a little more instability or volatility in the market. It's kind of like when things are bad, they're good for mortgages. And so the direct correlation is with the UMBS, with the mortgage-backed security, right? Mortgage companies, when you apply for a mortgage and you get a mortgage, they're selling the majority of the loans they originate, if not all the loans they originate. And so ultimately what happens is when the pricing, when there's higher demand in mortgage-backed securities, the prices go up. When they're selling them for higher prices, they're able to lower the rates because they can afford to have a better overall return because the prices are higher. Conversely, with the 10-year Treasury, when there's high interest and investment, demand among treasuries, the yield will decline, which is why we see a negative number next to that yield. And so in both cases, when we're seeing a negative yield in treasuries, we're lowering the yield on the 30-year fixed, and when we're seeing higher pricing on the mortgage-backed security, then we know lenders have the ability to then reduce the rates, which is what's leading to, on the bottom here, where we can see this little chart between positive, minimum, and negative right now, because we have kind of minimal changes between the 30-year mortgage-backed security note and the Treasury. So we're seeing minimal to positive movement, which means rates have a tendency to stay similar to where they are now. In coming days, we could see them move down even a little bit more, which would be fantastic again. And if the opposite was true, then we'd start to see us move towards that negative territory and see the possibility or the likelihood of rates increasing in the coming days or weeks. So I hope this is helpful. These are trends that you absolutely should be paying attention to and following to be able to know and be, again, a little more predictive as to where you think rates are expected to go. Any questions or any way that I can help support you having a better understanding of the market, don't hesitate to reach out.